we've got Ramin Nakisa, who's the founder of PensionCraft, joining in to give us a little perspective. Now, Ramin, this is something that was anticipating. I believe the street had a bit of a sense that there would be a number for the CPI in the month of May that would exceed expectations, and perhaps to a certain extent that reflected in the overnight performance of the equity markets of risk assets in general. You've had the Treasury yield on the 10-year benchmark that has climbed and is now substantially higher than 3%. How are you reading this latest CPI print, and could you give us the context in terms of how the economy is doing and the reaction from the Fed?
Inflation really hasn't come down much at all. If you look at core, that actually has come off the peak, but certainly if you include food and particularly shelter, which worries me because it's got such a large weighting in the CPI basket, and that continues to accelerate. So I really can't see inflation coming down hugely over the next 3, 4, 5, 6 months. And, you know, if that's the case, then equity simply hasn't priced in a lot of that bad news. And I think if you look at the multiple on the S&P 500, for example, currently it's around 20 times for the Shiller Cape. And typically, if we have inflation above 8%, you'd expect it to be trading like 20% below where we are today. If you look at, you know, margins for US companies, they're still at almost all-time highs. So at some point, something's got to give. And I think the equity market simply hasn't priced in the memo about inflation right now.
Okay, but let's talk about what happens going forward then, because I mean, widely expected that the Fed is going to continue to stay hawkish. They've said they're committed to reducing the size of their balance sheet. As you point out, earnings might just be a bit of a worry going forward. Growth might be a bit of a worry. So therefore, the largest central bank in the world, particularly more than anybody else, going to be playing a bit of a balancing act, aren't they? There's a possibility that we might see a recession. So how do international investors view this, and what would you say about emerging markets like India then?
If you just look at flows, if you look at the reverse repo facility with the Fed, you can see that it's above 2 trillion. And the reason for that, about 80% of that is money market funds, which have just ballooned recently because people want safety. I mean, why else would you forego all possibility of a return with a money market fund unless you're absolutely terrified? So I think the flows show pretty clearly that people are very scared. People are de-risking. A lot of the tourists that entered the equity market during the pandemic have now pretty much given up, I think. I still don't think we've seen full capitulation. If you look at growth valuations, for example, they're still pretty elevated relative to value stocks. So I think there's further to fall there. But I still don't think that people have fully priced in the impact of smaller margins. And if you look at broker forecasts, for example, we simply haven't seen any evidence that brokers have been revising down their forecasts with lower margins. You know, I think that's got to be something that changes in the near future. But it certainly doesn't look as if the Fed's going to ease off on quantitative tightening. If anything, it looks as if they're going to be more hawkish going forward. So I just don't see an easy way out of this without a repricing of risk assets. I think there's going to be more pain before we see a kind of dawn on the inflation front.
Certainly something to bear in mind ahead of several key meetings, I think, of central banks, not just in the US, but across the world. Thank you so much, Ramin, for taking the time.